Market Wrap. I'm Mo Ansari, and on our guest line is Dr. Dan Geller, creator of the Money Anxiety Index and author of the book Money Anxiety: How Financial Uncertainty Changes Consumer Behavior and the Economy. Dr. Geller is an experienced researcher, analyst, and an expert in statistical modeling. He developed the money anxiety concept and index, as well as a new segmentation method called behaviorology. He is frequently featured in the Wall Street Journal, New York Times, Bloomberg Newsweek, and has appeared on CNBC, Fox News Radio, and numerous regional programs. Dr. Geller, welcome back to Market Wrap.
Thank you, Mo. It's a pleasure to be on your great show again.
You recently wrote an article titled, "Your Instincts Can Save Your Life, but Also Drain Your Life Savings." Could you explain that? What do you mean by that?
Of course. The central question in this article is, can you trust your money to your instincts? And the answer is no, especially when the level of money anxiety is high. We tend to make the wrong financial decisions. And the article gives an example on how people made the wrong decision as far as bank deposits and pretty much gave up on earning 5 times higher yield during and in the aftermath of the Great Recession, because they made the wrong financial decision when money anxiety was higher.
So it's basically what you're saying is, do not make emotional decisions. When your anxiety levels are up, the less you do, usually the better off you're going to be.
Precisely. So when money anxiety is high, refrain from making instinctive decisions. Either wait until you calm down, so to speak, or better yet, have a professional like a financial advisor advise you, and this way you are negating the instinctive reaction by yourself, which is very likely to be the wrong one.
Let's talk about this. You also wrote, as you just mentioned, that right after the Great Recession, 2008 and 9, people ran out of the stock market, ran out of real estate, and put their money in bank deposits for safety. And they could have made a lot more money, and basically they made nothing, getting zero on there. Why do people do that? Why do always people make the wrong decision at the wrong time? Is this just a survival instinct that kicks into people? Is it fear? Is it what is it?
No, you said it right, survival. And for the defense of all of us, it's not our fault. We are built this way. You see, the instinct that told us to take money out or move it from CDs to liquid account and lose money on the yield came from our reptilian part of the brain, which was the first part of the brain to evolve. And the sole purpose of the reptilian brain was basically to maintain our survival when we still lived, in caves. So basically, the purpose of this part of the brain was that when we saw a tiger in the wood, we ran. This was an instinctive decision. We didn't have to analyze, how fast the tiger is going to run and all that. We ran. Now, this instinct stayed with us, even though we don't use it for survival anymore, but we still use it, and that's the mistake. So it's not our fault. We are built this way, but we need to learn how not to use it in cases that are not life and death. And that's why it's good either to make the decision when we are not under stress, financial stress, or to have someone help us make the decision, such as an independent, objective financial advisor.
In the study of behavioral economics, there's something known as prospect theory. Tell us about the theory and how it impacts financial decision making.
Okay, so the prevailing theory before prospect theory came in the early 70s was utility theory, which basically said that people are willing to take a risk based on the amount of money that they have, meaning that the more a person has, the more assets they have, the higher the threshold, the risk level that they are willing to take. And then in the early 70s, Kahneman and Tversky came up with prospect theory, which basically they said that's not the whole picture. There is another aspect here, which is basically our instincts or the way we feel about it emotionally. And this is a factor that needs to be incorporated into the risk-making decision. And I would say that, right now prospect theory is the prevailing theory about risk-based decisions.
We are talking to Dr. Dan Geller, creator of Money Anxiety Index and author of the book Money Anxiety: How Financial Uncertainty Changes Consumer Behavior and the Economy. Dr. Geller, in the recent article you wrote, the link between the level of financial anxiety and the economy is very strong and significant. And the more we recognize and utilize money anxiety in economic and financial models, the greater our ability to understand and project shifts in the economic environment will be. So at this moment, do you think you see any coming shifts in the economic environment?
No, not in the fundamentals. So, and that's a very relevant question even to today. We see what's happening in the equity market. So, but the fundamentals of the economy are solid. We saw the unemployment a little bit on the low side, 100,000 and change in new jobs. Still very good, considering that the 3 months average is over 200,000 jobs. So that's still very good, very solid. Unemployment stays at 4.1. People are spending, so the fundamentals are good. But a certain segment of the population, mostly the retail investors, are panicking a little bit. And when they see the equity market going down like it is today, they are tempted to sell. And that's not the right approach.
That is usually not the right approach, as you just said. But, we're talking about interest rates going up, inflation going up, a trade war every day, and we've got skirmishes, and, one side is doing this and the other side is reciprocating, and so on and so forth. How's the anxiety index right now? Has it gone up over the last month or two, or has it come down, or what does it look like?
The money anxiety index is pretty much steady, fairly low, but it is low, but steady because it's based on fundamentals. What you mentioned now, for instance, about trade wars, this is still a perception. There is no trade war. This is just jockeying for position for negotiations on trade. Those tariffs are not going, if any, if ever, are not going to take effect for months. This is just jockeying for positions because the U.S. and China are going to enter into negotiations, and at the end of the day, there will be some compromises on both sides, and life goes on. So we hear about all those tariffs, and we are saying trade wars, and the media likes to hype it because that's what the media does. And for the retail investor, it's scary. But as I mentioned earlier, it would be the wrong approach to act now under high money anxiety when it pertains to the market without consulting with other people or just waiting until things come down a little bit.
Dr. Geller, let's talk about the money anxiety index. How do you calculate it? What are the components of the money anxiety index, and what makes it go up and what makes it go down?
Okay, basically, if we look at the U.S. economy, there are two engines, so to speak, to the economy. One is the spending and one is savings. Roughly, each one of them is about $12 trillion. And the interaction between spending and savings pretty much determines which way the economy is going. When spending goes up, the economy prospers because 70% of our economy is based on consumption. And when it goes the other way around, such was the case during the Great Recession, when savings went up tremendously and spending went down, we are entering a recession. Now, what the money anxiety is doing, it looks at what people do with their money, not what they say. That's the uniqueness of the money anxiety index. It's not a subjective index that is based on questionnaires, like the consumer confidence, consumer sentiment. Those are survey-based subjective indices that are based on what people say. The money anxiety index goes by what people do with their money, not what they say. So we measure what they do, and we are able to see what if they are spending more or saving less, and this way we measure the level of financial anxiety.
So where are we right now? Are we spending more or saving more? Are people scared or they're not scared?
Money anxiety is relatively low. It's pretty much to the same level that it was before the Great Recession at 50.1. So bottom line, yes, we are spending more and saving less than we did in the last decade or so.
Tell us more about the book, Money Anxiety, How Financial Uncertainty Changes Consumer Behavior and the Economy. How does it benefit investors, and how does it benefit businesses?
The Money Anxiety books gives examples of how our instinctive decision impacts our financials, both as far as investors and just in our everyday life. And it also explains why this phenomena exists, so that businesses and investors can understand the root cause of our financial decision under high level of anxiety and why we need to avoid it. So for businesses, it's a wonderful tool to basically plan for changes in the economy. If we are going into a recession, there are certain segments of the economy that actually prosper. And the book gives an example, for instance, in the automobile business, services go up while car sales go down, and vice versa. And businesses can definitely use the money anxiety concept to plan better for the cycles in the economy.
Dr. Geller, thank you so much for taking the time to be with us today on Market Wrap.
Well, it's a pleasure anytime.
Have a great weekend. That's Dr. Dan Geller. He's the creator of the Money Anxiety Index, author of the book Money Anxiety, How Financial Uncertainty Changes Consumer Behavior and the Economy. The first two callers from each listening area, call right now, and you're going to get a free copy of Money Anxiety. It's a great read. You can call right now and get a free copy. The first two callers from each listening area, call right now, pound 250 on the cell phone, talk to Mo, pound 250 on the cell phone, talk to Mo. That's what you dial, that's what you say. And don't forget, next seminar is going to be on the 21st.